Welcome back to the deep dive. Our listeners, you come to us for clarity, really. You're looking for those high-quality assets, the companies with genuinely durable moats, and, I think most critically, where you can find valuation dislocations that give you a real margin of safety.
Absolutely. And for the critical investor, a huge part of the game is navigating complexity. I mean, figuring out where that complexity is actually hiding a great asset versus just being, well, a mess.
That brings us perfectly to our subject today, London Stock Exchange Group PLC, or LSEG.
A fascinating and, let's be honest, a very complicated company. It's one that really deserves a deep, critical look.
Okay, so let's get this out of the way right up front, because the name itself is almost completely misleading now.
It really is.
We are not talking about the London Stock Exchange, the place where you trade stocks. That part of the business now generates less than 4% of group revenue. It's almost a rounding error.
Vestigial, really. What we're actually talking about is a massive global financial data powerhouse. A company that was totally transformed by that colossal $27 billion acquisition of Refinitiv back in 2021.
So that's the defining question for this deep dive then, isn't it? Can LSEG actually complete that transformation?
That's it, exactly. I mean,
Yeah.
Can they really go from being this sort of slow-moving legacy infrastructure provider to becoming the truly indispensable high-tech operating system for global finance?
And if they can, does the market get it? Or is it withholding that premium valuation that you see with other top-tier data companies?
Our mission, then, is to really dig into that investment thesis. Is LSEG correctly priced as, a reliable cash-gushing financial utility, but maybe a slow grower?
Or is the market just completely missing the boat here, overlooking its potential as a true high-growth beta compounder, where the current price is offering us a sort of complexity-driven margin of safety?
To figure that out, we have to stress test their competitive moats. We need to analyze the efficiency of that huge capital allocation. I mean, $27 billion has to be justified. And we need to scrutinize the growth story, especially around this huge alliance with Microsoft and the whole AI disruption narrative.
All right, we've set the stage. Utility or compounder. To start, we have to look at the foundation, which is that Refinitiv deal. It changed. Well, it changed everything.
It really did. And you have to appreciate the scale of it. It was a monumental pivot.
Let's start there, the transformation.
The structural pivot here is just,
Yeah.
it's huge. And that $27 billion acquisition of Refinitiv wasn't just some opportunistic deal for scale. Many analysts, and I think correctly, called it a survival trade.
A survival trade. That's a very strong phrase. What were they surviving?
They were surviving decline, really.
Yeah.
Structural decline and regional relevance.
Yeah.
LSEG was just so heavily exposed to the shrinking UK equity listing market.
Right, which was only made worse by Brexit.
Absolutely. The regulatory mess, the trading activity moving away from London, it threatened their whole long-term relevance. So Refinitiv, almost overnight, diversified them into this global currency-agnostic data market. It pulled them out of a slow, shrinking pond and dropped them into the ocean.
The numbers are just stark. Data and analytics, or DNA, is now about 70% of group revenue.
70%. That one fact means the whole investment thesis has shifted from a cyclical transaction-based model to a subscription-based, highly predictable one.
And that's the cornerstone of the bull case, right? This recurring revenue.
It's the mark of quality. About 73% of their top line is now subscription-based. That gives you incredible cash flow visibility.
And for you, as an investor, this is critical. It totally changes the risk profile. It lets them carry more debt than a pure exchange ever could, and it insulates them from that gut-wrenching volatility when markets turn down. They don't just live or die by daily trading volumes anymore.
But, and this is a big but, that protection comes with a new vulnerability. The risk shifts. It's no longer market volume risk, it's client headcount risk.
Seat count risk.
Exactly. And this is the friction point that you have to model. When a major client consolidates, I mean, the massive UBS and Credit Suisse merger is the perfect case study, what's the first thing they do?
They rationalize data contracts, get rid of all the duplicate terminal licenses.
Precisely. And that rationalization creates this persistent, unavoidable drag on their annual subscription value growth, their ASV. Organic growth might be, say, 6%, but if your biggest clients are cutting 1.5% in duplicate seats, your net growth takes a real hit.
And we saw that in the numbers, didn't we? In the 2023-2024 period, management had to address this directly with analysts.
They did. They got grilled on why headline ASV growth slowed from a healthy 6.4% down to 5.6%. That 80 basis point drop was largely blamed on that exact consolidation friction from the big bank mergers.
It really highlights the difference between real volume growth and just pricing power having to overcome this structural churn.
It does. And that's the kind of nuance you have to watch. It's what fuels the bear case. That, look, despite the quality, LSEG just doesn't have the automatic growth of an S&P Global or an MSCI, where assets just flow into their indexes. LSEG has to fight for every point of growth.
Okay, so let's drill down from that structural shift into the segments themselves. They restructured into 3 core divisions in 2024. We need to find out where the growth alpha is actually hiding, because it's not spread evenly.
Right, first up is Data and Analytics, D&A. This is the engine room. Biggest segment, about 47% of total income. Growth here is steady, but it's not explosive.
Q3 2025 came in at 4.9% organic growth.
Respectable, but like you said, a sub 5% growth rate isn't going to get you a premium compounder multiple.
So where's that growth coming from?
Mostly from price increases, in line with inflation, plus a little bit of cross-selling. It's not coming from stealing massive market share or signing up tons of new users. And within D&A, there's a really telling split.
Between workflows and data and feeds.
Exactly. The workflows part, which includes the actual terminals, is lagging badly. It grew at only 3%. Meanwhile, the enterprise data and feeds, the invisible plumbing, grew at a much healthier 6.6%.
And that 3% number tells you everything you need to know about the terminal war with Bloomberg, doesn't it?
It confirms it's a brutal, high-friction grind. They are struggling to push their workspace desktop product into that high-end front office world. But their enterprise data feeds, the stuff that fuels the algorithms and compliance systems, that's where their strength and their stickiness really lies.
So if DNA is the reliable, slow and steady utility, where's the double-digit growth engine that supports the compounder thesis?
That brings us to the second segment, FTSE Russell and Risk Intelligence. This is where you see the real acceleration.
Let's start with risk intelligence, and specifically the WorldCheck product.
WorldCheck is a genuine star. It delivered 13.9% organic growth in Q3 2025. And this isn't cyclical. This is driven by a massive, non-negotiable secular tailwind.
Which is global complexity.
It's the ever-increasing complexity of global sanctions, know your customer rules, anti-money laundering compliance. Every time a government issues a new sanctions list, it creates an immediate, urgent need for LSEG's data.
So in this case, complexity is literally the product they sell. The riskier and more opaque the world gets, the more valuable WorldCheck becomes.
Precisely. Its value isn't just the data, it's the audit trail. It's insurance against billion-dollar regulatory fines. The demand for this is almost perfectly inelastic.
And then you've got FTSE Russell, the index provider, grew at a very attractive 9.3%.
This is beautiful, high-quality, asset-based revenue. It just passively benefits from the unstoppable global trend towards passive investing and ETFs. LSEG gets a tiny slice, a few basis points, on trillions in assets under management benchmarked to their indexes. As markets go up and funds flow in, their revenue rises without them having to make a single sales call.
Finally, we've got the markets division. This is where the cyclical upside is, and it's really dominated by their majority stake in Tradeweb.
Tradeweb is an absolute monster. It consistently delivers double-digit growth. I think it was 17.8% in FY 2024. It's just perfectly positioned to capture the ongoing electronification of the fixed income market.
This is a huge point. Equities are almost fully electronic, but bonds derivatives. A lot of that is still done over the phone, old school.
And Tradeweb is just eating that world alive. It gives LSEG a high-growth vector in a market that's still pretty early in its digital transformation. The value proposition, transparency, tighter spread, speed, it's just irresistible. It gives LSEG a high-octane kicker that a pure data company wouldn't have.
So if you put it all together, the overall company growth of, say, 6.5 to 7.5% isn't just sticky subscriptions. It's being materially boosted by these high-margin, double-digit pockets in risk intelligence and Tradeweb.
It confirms that all-weather thesis. If the market crashes, volatility helps their clearinghouse, and regulatory scrutiny boosts WorldCheck. If the market is calm, the DNA subscriptions provide that stable cash flow. It's a beautifully balanced portfolio, which, arguably should command a higher multiple.
Which brings us to the next section. We've established the quality of the revenue. Now we have to talk about the moat. LSEG bet $27 billion that their competitive advantage is wide enough to justify that price.
So we need to stress test it.
Exactly,
Right.
starting with data and analytics.
Okay, so the moat in DNA. As we said, it's not built on having a better product than the Bloomberg terminal. not in that high-end front office fight.
It's all about switching costs.
It is almost entirely about high switching costs and deep, often invisible integration into how their clients operate. This is the difference between a nice-to-have product and a mission-critical utility.
Let's get into the mechanics of that friction. How deep does that integration actually go?
It's deepest in the middle and back office. That's where the real money and the real risk management happens. A trader on the front line might complain about a clunky interface, but the data feeds themselves. They were hardwired into the core functions of the bank.
You're talking about algorithmic trading engines, risk management systems, regulatory reporting.
All of it. So when a huge global bank builds its entire internal risk model around LSEG's proprietary data taxonomy, let's use PERMI-D as the example, they are effectively locked in.
Okay, explain PERMI. Why is it so hard to replace?
Think of PERMI as LSEG's unique social security number for every single financial instrument, company, and asset on the planet. When a bank's entire data architecture, tens of thousands of lines of code, all reference financial positions using that ID system.
You can't just swap it out. You'd have to recode and re-audit your entire mission-critical infrastructure to use a competitor system. The operational risk is it's astronomical. No CIO is signing off on that.
Exactly. Ripping those feeds out isn't just a cost issue, it's a compliance nightmare. And the fact that clients just sort of grudgingly accept price increases year after year proves it. It's hard dollar evidence that the switching cost is higher than the price hike.
And the new workspace platform, their new desktop, the strategy there is to make that switching cost personal, right? Using a Microsoft alliance.
That is the explicit strategy. It's brilliant. They know they can't win on aesthetics against Bloomberg, so instead they embed LSEG data into the tools that every analyst already lives in all day, Microsoft Teams and Excel.
So the goal is, if your complex Excel models rely on an LSEG plugin to run, the second you try to use a competitor, those models just break.
Instantly. The inconvenience becomes immediate and personal. It weaponizes convenience. It makes their data flow part of your workflow, not some separate application you choose to open.
This is where we have to apply some serious scrutiny, though. Management claims that 90% of their data revenue is non-replicable by large language models. That's a very bold claim today.
A very bold claim, and we have to break it down. They divide that non-replicable data into two buckets, which we can call the physics moat and the network moat. Together, they defend about 70% of the DNA revenue.
Let's start with the physics moat. That's 45% of the revenue, all about real-time data.
Right, and this is a latency game. AI cannot break the laws of physics. An LLM can't just hallucinate a live millisecond-accurate price feed from an exchange. LSEG has physical, dedicated fiber optic lines running into 575 exchanges globally. Their servers are often sitting right next to the exchange's matching engines.
So that physical infrastructure, the fiber, the proprietary software, the data centers, that's a multi-billion-dollar capital expenditure barrier.
A huge one. A new software-only startup can't just scrape their way into this game. You can't bypass the physics of speed and proximity. It's a capital moat, not a software one.
What about the network mode? This is the other 25%. This isn't about speed, it's about exclusivity.
This is the data that an LLM can't see because it's not public. This is dealer-contributed bond pricing for illiquid markets or private M&A deal data. This data is privately submitted by market participants under NDA only to LSEG's platform because LSEG is the trusted utility.
Which creates a classic network effect.
A powerful one. The more bond dealers who contribute their prices, the more valuable the whole data set becomes, which attracts more users, which incentivizes more dealers to contribute. It's a self-reinforcing loop.
But we have to be critical. If 70% is protected by those moats, what about the other 30%? And they admit 10% is highly vulnerable.
They do. And that 10% is stuff like basic consensus estimates, news headlines, simple corporate actions. That stuff is rapidly being commoditized by AI and low-cost players. The pressure there is only going to get worse.
Okay, let's move to the regulatory mode, which is probably the strongest part of the whole structure. LCH and SwapClear.
This is a fortress. It's built on regulation, not code. It came directly out of the 2008 financial crisis and the mandate for central clearing of OTC derivatives. LSEG's majority ownership of LCH, the London clearinghouse, makes it a systemically important piece of global finance.
And SwapClear is basically a monopoly, right? It clears something like 90% of the world's interest rate swaps. Why can't anyone break into that?
It's one thing, the irreplaceable netting benefit. Banks have to clear their positions where all the other liquidity is. If a big bank has hundreds of different swap positions, Clearing them all through SwapClear lets them offset those positions against each other.
Give us a simple example of how that works.
Okay, imagine a bank has a positive exposure of $1 billion to client A and a negative exposure of $900 million to client B.
Uh,
If they clear both through SwapClear, their net exposure is only $100 million. That's all they have to post margin against.
But if they used a smaller competitor without that liquidity pool,
They lose the netting benefit. They might have to post collateral against the full $1.9 billion gross exposure. It would be economically crippling. They are locked in by capital efficiency requirements.
it's the ultimate lock-in.
It is. And on top of that, LCH's open access model is just brilliant. They'll clear trades that happen on rival exchanges. So competitors can't just bypass them. LCH stays at the center of the universe no matter where a trade starts.
So despite all these incredible moats, the financials tell a slightly different story, or at least a more complicated one. This brings us to the financial picture, and specifically that ROIC problem.
Right. If the moat is so great, the return on capital should be spectacular. But reported return on invested capital is, well, it's terrible. It's in the 3 to 7% range post-acquisition. For an investor focused on capital efficiency, that's a massive red flag.
And that low number is because of the massive goodwill, over 20 billion pounds, from the Refinitiv deal. But hold on, if we just ignore 20 billion pounds of goodwill to make the ROIC look better, aren't we just moving the goalposts? I mean, isn't that just deluding ourselves about the true cost of the asset?
That is the bear trap, and it's a totally fair challenge. That thin spread between ROIC and their cost of capital suggests the moat was bought at a very full price. It raises real questions about the capital allocation.
Because how do you counter that?
You have to differentiate between accounting metrics and economic reality, and the reality is all about the cash flow. That's where we have to go next.
Okay, section 3. Let's tackle that ROIC conundrum head on. The bull case has to have a powerful counterargument.
And it does. It's all about free cash flow. The quality of LSEG's earnings is exceptionally high. They convert roughly 100% of their adjusted earnings directly into free cash flow. That is incredibly rare.
And here's the key takeaway for you, the listener. You have to separate the accounting from the economics. Free cash flow is consistently and significantly higher than reported net income.
Why? Because of those enormous non-cash amortization charges from the Refinitiv goodwill. We're talking hundreds of millions, sometimes over £1 billion a year, in charges that are required by accounting rules but don't actually cost the company any cash.
So while statutory EPS looks depressed, the actual cash-generating power of the business is enormous. And that cash can be used to pay down debt, invest, and return capital to shareholders.
Exactly. So for LSEG, you have to basically throw statutory EPS out the window as a valuation metric. It's all about free cash flow per share. They're expected to generate over £2.4 billion of it in 2025. That high cash conversion is the financial moat.
Let's move to margins. On the top line, LSEG looks great. Gross margins are over 85%, which is what you'd expect from a data business. But when you look at EBITDA margins, there's a gap.
There is. LSEG's EBITDA margins are approaching 50%, which is very profitable. But you benchmark them against a hyper-efficient exchange like CME Group, which runs at about 68%. That's an 18-point gap. It's glaring.
What explains that? Is it just inefficiency?
It's the complexity of the business model. CME is relatively passive. They run a matching engine. LSEG has to actively aggregate, clean, normalize, and distribute data from hundreds of sources. That active curation and complex infrastructure is just intrinsically more expensive to run than a central order book.
So the margin gap is structural, not necessarily bad management, but the bull thesis requires that gap to close.
Yet it is. Through the synergies from the Refinitiv deal, they're showing classic operating leverage revenue is growing faster than costs. Management actually raised their margin guidance for 2025, targeting a 100 basis point improvement. That's a huge signal of confidence.
And that's coming from stripping out duplicate costs, consolidating data centers, the boring hard work of integration.
Precisely. That is the execution that validates the whole deal. And as revenue grows, especially from high-margin areas like risk intelligence, that fixed cost base gets diluted, and margins should naturally expand over time.
Let's revisit pricing power. How much of the growth is real volume versus just price hikes?
They have moderate, not aggressive, pricing power. They've been able to push through price increases consistent with inflation, which contributes about 3.5% to their growth. That's solid. It shows the product is sticky.
But that inflation plus ceiling brings us back to that idea of grudging acceptance, doesn't it? They're tolerated as a lower-cost alternative to Bloomberg.
That's right. And that value position is a great defense against Bloomberg, which can cost upwards of $24,000 a seat. But it does cap their ability to be super aggressive on price, unlike a true monopoly like MSCI. If they squeeze too hard, they risk pushing users to low-cost disruptors.
So it's a delicate balancing act. Strong enough to prove stickiness, but constrained by their strategic position in the market.
It is. They have to keep that balance, especially now while they're in the middle of this massive, risky migration to the new workspace platform.
Which brings us to execution risk. The strategy is sound, but the implementation is everything. Let's dissect the Microsoft Strategic Alliance. This is supposed to be the next big growth engine.
The rationale here is pure capital allocation genius, really. LSEG realized building out their own cloud infrastructure was too slow and too expensive, so they essentially outsourced their technological modernization to the best in the business.
And the equity stake is key. Microsoft now owns about 4% of LSEG.
Which locks them in. It makes them a partner, not a potential competitor. It creates total alignment and gives LSEG priority access to Azure's cloud and, more importantly, its AI engineering talent. This is what underpins that LSEG Everywhere strategy.
Explain that pivot from being a destination, a separate app you have to open, to being embedded in the workflow.
This is the really high-value part. The data now flows directly into the tools everyone already uses, like Teams and Excel, through secure APIs. This makes them so much stickier, especially for lighter users like wealth managers or corporate treasurers who don't need a full-blown terminal.
But how do they monetize that if they aren't selling a terminal seat?
They shift the pricing model. Instead of licensing per seat, they monetize the data flow itself through enterprise licenses and usage-based API fees. A company can now embed LSEG data into its own proprietary apps and pay based on consumption. It opens up a whole new market for them.
It's an astute move, but we have to be skeptical about how quickly this translates to revenue, right?
Absolutely. Investors have to be skeptical. The revenue synergies are backloaded. The immediate impact is tech modernization and stickiness, not a sudden sales spike. We need management to be much clearer about when this partnership will generate material attributable growth. They've been a bit vague on that.
Now let's talk about operational resilience, or maybe the lack of it. This is where the execution risk really bites.
The failures have been bad and very public. In July 2024, and then again in late 2025, the new workspace platform had severe global outages. News and pricing feeds just went down.
For a company that pitches itself as the mission-critical plumbing of global finance, 2 major outages in 18 months is it's unacceptable.
It's a breach of trust. That's the foundation of their moat. These outages erode client confidence and just highlight how fragile some of that legacy tech they're trying to replace really is. It makes the Microsoft migration even more urgent, but it also costs them credibility.
And that leads directly to the churn risk. This migration from the old Icon platform to Workspace is a huge, multi-year project involving hundreds of thousands of users who are being forced to change how they work.
This is probably the single biggest short-term risk they face. If there are functionality gaps or stability problems during this forced transition, it's a golden opportunity for competitors. Every migration creates a window for rivals to poach unhappy customers. A spike in churn here would be catastrophic for the re-rating thesis.
And on top of that, you have the external headwinds, the terminal decline pressure, for one.
Right. They're not really beating Bloomberg in the high end, so they're focused on that price-sensitive value segment. But they're not just fighting Bloomberg. They're fighting a new generation of low-cost fintechs. They have to keep investing in Workspace just to stay ahead of them.
And the client consolidation threat isn't going away.
It's a structural headwind. The UBS Credit Suisse merger is the archetype. It just reduces the total number of seats in the market. Management can try to cross-sell more services to the new, bigger bank, but they can't stop the initial seat count reduction.
Then there's geopolitical fragmentation.
This is a tricky one. Regulatory divergence between, say, the UK and the EU, or the US and China, could force LSEG to build redundant local infrastructure, which would increase costs and hurt margins.
But there's a silver lining there for them, isn't there?
There is. It's a structural hedge. The more complex and fragmented the world gets, the higher the demand for their World Check Risk Intelligence product. So while fragmentation might increase their costs, it also increases demand for one of their highest margin products. In that sense, they're a pretty good all-weather geopolitical hedge.
Okay, we've covered the moats, the execution, the risks. Let's get to the brass tacks valuation. LSEG clearly trades at what people are calling a complexity discount. The question is it warranted or is it a margin of safety?
If you look at late 2025 pricing, you're seeing LSEG trade at a forward PE of around 19 to 20 times and an EV to EBITDA multiple of about 12. That's our baseline.
And when you compare that to the pure play US data compounders, the gap is it's huge. S&P Global is at 31 times PE, MSCI is at 34, and they have a similar recurring revenue mix.
It tells you everything. The market is not giving LSEG the information services valuation yet. It's still viewing them as an exchange that has a data business. It's applying a conglomerate discount and pricing them closer to a European peer like Deutsche Börse.
So the market is valuing the legacy, not the future. Why is the discount so big? Is it the complexity, the UK listing, the debt hangover?
It's a mix of all three, amplified by that execution risk we just talked about.
Yeah.
But that is precisely where the opportunity lies for an investor.
What's the catalyst for a re-rating?
If they can de-risk the Refinitiv integration, consistently deliver that high single-digit organic growth, and really prove they are a data co, a re-rating toward 25 times PE is entirely plausible. That multiple expansion alone gives you a significant return.
What about management quality? How have they handled the balance sheet after taking on all that debt?
Exceptionally well. Post-Refinitiv, leverage was over 3 times net debt to EBITDA. They have disciplined that down to an expected 1.9 times by late 2025. That rapid deleveraging shows you the incredible cash generation power of the business and restores a ton of financial flexibility.
And that allows them to shift focus to shareholder returns, like the big £2 billion buyback program.
That buyback is strategically brilliant. Yes, it returns cash, but its main purpose is to manage the share overhang from the Blackstone and Thomson Reuters consortium, who have been required sellers of the stock. By buying those shares back, management supports the price and reduces the share count, which juices the FCF per share. It's smart financial engineering.
And the insider signal looks good, too.
The CEO, David Schwimmer, notably bought shares in August 2025. That's a clear signal of personal confidence in the valuation. You combine that with a progressive dividend policy, and it's clear management thinks that the stock is undervalued, and they're actively trying to close that discount.
All right, last thing. Let's stress test the downside. What's the single most existential bear case here?
The biggest long-term risk is still generative AI just completely commoditizing financial data aggregation, especially at the low end of the market. If an LLM can synthesize all public data cheaper and faster than LSEG, that 10% of their revenue that's exposed could expand very, very quickly.
So what's the floor we need to watch for in the numbers?
The floor is 4% organic growth in the core DNA division. If they consistently fall below that, the whole investment thesis breaks. The multiple will compress back towards 15 to 17 times PE, and it'll be priced as a slow growth utility again. Sustaining 6+% growth is non-negotiable for the bull case.
And the other big, low-probability tail risk?
Systemic risk at LCH. It's incredibly sticky, but it clears trillions of dollars in notional risk. It exposes LSEG to a theoretical black swan market failure. The chances are minuscule, but you have to acknowledge that risk when you own the central counterparty for the entire global financial system.
Okay, we've been through all of it. Complexity, cost, competition. What's the final verdict for the critical investor? Is this a buy, hold, or sell?
I think the evidence supports a cautiously bullish stance. This is a high-quality, wide-moat asset that is trading at a genuine, unwarranted complexity discount. The financial performance is validating the strategy. The growth is accelerating, margins are expanding, and the cash flow is immense.
So the path to superior returns over the next few years is all about that multiple expansion. But it's contingent on two very specific, monitorable things.
Absolutely. Thing one, you have to watch customer retention rates like a hawk during this workspace migration.
Right.
They cannot afford to lose clients, especially after those outages. Execution has to be flawless.
And thing two,
The tangible, revenue-generating delivery of the Microsoft and AI integration. We need to see real growth from new products, not just from inflation plus price hikes.
So the recommendation is to accumulate the stock using any volatility from the integration or a broader market dip as your entry point. This isn't a passive hold, it's an active opportunity to monetize a complexity discount.
It's got scale, quality, cash flow, and a clear catalyst for a re-rating, assuming management can stick the landing on the tech transition.
Which brings us to our final provocative thought for you to think about. We spent this whole deep dive asking if LSEG can compete with Bloomberg or get the multiple of S&P Global.
But what if that's entirely the wrong way to look at it? What if the ultimate irreplaceable value of LSEG isn't in winning the desktop war at all?
but in being the unseen, regulated, critical plumbing that financial institutions simply must pay for. The LCH, the permittee data taxonomy, the world check compliance data.
Exactly. The stuff that no algorithm, no matter how smart, can replicate, and that no competitor can replace without taking on massive systemic risk and capital costs.
We have to watch and see if LSEG can successfully transform its complex structure from being the source of a conglomerate discount into being an intentional, structural, all-weather hedge against financial market risk itself. If the market ever realizes that, that is what could finally unlock the premium this stock deserves.
A fascinating thesis.
That's all for this deep dive. Thank you for joining us. We hope you feel well equipped to tackle this complexity.